this is now, I finished part one. This is part two. This is
Fantastic.
about my journey and a quick snapshot. This is me in the middle. I came as a boat person, a genuine boat person in 1982. We drifted out in the sea, got picked up by the International Red Cross, placed on an island in Malaysia called Pulau Bedong.
Mm-hmm.
At one time, it was a hellhole and the world's most populated per square meter. So if you Google up Pulau Bedong, you'll be able to tell or see what was going on back in the late 70s and 80s. I'm a civil engineer.
I think we went through there as well.
Was that sorry?
I think we went through there as well.
There you go. Do you remember the statue then? It's still there. Yeah.
I don't remember the statue. I was 3 when it passed through.
This is very iconic. Yeah, it's still there.
Okay.
Anyway, but back to the slides. I'm a civil engineer by profession, 22 years of real estate experience in property development, working for large ASX-listed developers. I worked on the Palm Jebel, all the way up to the GFC, and then all these expats had to go home, pack their bags, and go home. That wasn't me. Licensed real estate agent.
You worked on the Palm.
Yeah, I worked on the Palm. I managed the crescents and trunk and all that. For the Dubai government's development arm, basically. That's another story for another day. This is a lead up to what I'm about to explain. I'm involved in property syndications because I like doing deals. I'm now semi-retired in talking marks, and I do run a branded mortgage broking franchise, specializing in home loans, and that's me. In case, just a small shout out to what I do. Okay, now we're talking about property syndications. Very quick snapshot, in terms of what it is. Ignore this for the time being. I'll explain it in very simple layman's terms. You're pretty much embedded with the developer as an equity partner.
Okay.
So whatever profits they make from the project, minus the fees, is what you make. Mm-hmm. These syndications are generally ASIC compliant. So they got to lodge paperwork with ASIC, and also look for syndications that run a unit trust scheme. Now, I'll explain what a unit trust is in my next slide. Most syndications are only for wholesale investors. When I say wholesale investors, these investors, at a minimum, need to be sophisticated investors. Now, I'll explain that also on my next slide.
Okay.
The time frame and returns in a syndication is not fixed. So, very big difference between a syndication and a fund.
Yep.
So, with funds, you buy a share, it's worth this much today. You might get fixed dividends, quarterly, yearly, or whatever it is. These syndications are not funds, so there's a difference there. Look out for conflict of interest in the syndications, especially the middleman. So, for example, the property developer might say, yep, I got this product, I need to repackage it, I need to look for investors, and then Mr. Middleman says, yeah, no worries. I got clients, especially in the financial planning space. Not all financial planners are bad or evil, but particularly in the financial planning space, because you would probably put sophisticated investors and financial planners hand in hand, because when you get to a stage where you have a certain amount of money, you want to go to a financial planner. And it's these financial planners that actually take cream off, in terms of their fees or a kickback, and introduce you to syndications. Not every syndication is a money-making scheme, or is actually in your best interest. So that's a big point to take note of. No property syndication is the same as the other. It's all dependent on the risk, the reward, the duration, and track record. Never invest in a syndication from someone who hasn't done a project of that size or has experience in that kind of development before, because you're just gambling. You might as well take it to the casino.
Now, the last time we spoke, you mentioned that you've been involved in 15 syndications. Is that right?
We can talk about that. When I say I'm involved, I don't do the nitty gritty. Manage the property development space or each project. What I normally do is just I look at the projects from a financial perspective, in terms of the information provided. Now it passes. I'll be able to tell you a bit more later on. But if it passes my own hurdles, I invest in it, and that forms part of what I'm trying to share with you guys. In terms of how I've managed to do passive income or do what I want to talk Mark's, you know, I'm semi-retired basically because I rely on the passive income to sustain my living expenses. But I'll talk about that in the next few slides. And then I also mentioned there is a difference between debt and equity.
Big
and
difference.
As I said, yeah, not many people understand. You know, when you invest in a syndication, make sure that it's not redressed with you know, with saying that it is equity, but it's actually debt, which means that it's a loan to a syndication or a loan to the project. Big difference. So just make sure that you do understand when you do look at these syndications, you're investing as an equity investor, not as a debt. You know, not someone who's lending out money. Now, typically, I'm not saying that all syndications fall into this this particular chart. Typically, when you talk about and this goes for land, you can probably change some of the headings to make it apartments or units or commercial if you want. But typically, you've got unzoned land, which is your farmland or whatever land it is that's ripe for development. It then needs to go through strategic planning and statutory planning. You then have to get planning approval and the project launches, which then means that you'll be able to, as a developer, you'll be able to get debt funding and start construction. And that's typically also linked with sales, which is that project launch sales. And then when it finishes, you've got settlements, and then that's when the profits come back, right? And then when the profits, you know, at settlement, profits come back. This is the last stage. This is the home owner, mum and dad, investor, homeowner. This is where a majority of Australians fall in when they actually buy an apartment that's finished, a house and land that's finished, or whatever is available in the market. When I talk about syndications, there's very different risk profiles, and now I'm generalizing here. Typically, syndications fall within this category where it's pretty much de-risked to a lower risk. You know, and this is where the developer says, "Yep, I've done all the hard yards. I've done this bit. I've done this bit. Done all the hard yards. I'm ready to now, you know, package it up, get investors on board to move it to the next phase, because without enough equity cover, you can't borrow money for construction. Okay, so you have to have skin in the game, basically, you know, in order for a funder to lend you money, and that's what's happening. Now, there are syndications that start from the strategic planning phase, so from here all the way to here, and then there are syndications that start from unzoned land all the way to the end. Very rarely would I suggest people investing in these areas, but there are unicorns. And I probably will touch a bit about it if I've got enough time at the end on one of the projects that we've got that I consider a unicorn deal. Okay. So what is a sophisticated investor? This is straight out of the textbook or online. You need to have an income of 250 grand or more per year for the last 2 years, or hold net assets of at least 2.5 million. You need a certificate issued out by your accountant, and you know that's pretty much what it says. Obviously, speak to your accountant to make sure that you satisfy, or otherwise, okay? Because if you don't have this credential, it's very hard for you to invest in a syndicate. Now, there are ways around it, and I'll explain to you. So this is my next bit. My tip: be very good friends with your tax accountant. All right. Whether you've known someone from uni or whatever, and now they're an accountant, be best friends with them. This is, I can't stress enough, because your accountant, a lot of the accountants are very conservative, which is good. Okay, they're like a check for you, a check and balance for you. They also, if they're worth their money in their weight, they will also be able to tell you about what the best tax structure is for your circumstances.
Okay.
Notwithstanding the wealth manager, okay, or the financial planning side of things, okay. So financial planner and tax accountants sometimes work hand in hand. Sometimes are the same people as well. So you just need to make sure, you know, over time you'll be able to pick up who's good and who's not, and making sure that that they're very upfront with you in terms of their fees. Not to tread on any of those other professions. There are exceptions to invest into syndications, like I said. You don't necessarily need to be a sophisticated investor. However, you need to be great friends, family, or an acquaintance with the developer or with the directors of the project or with the owner of the project. And you'll be able to pretty much they'll be able to say, yep, you're us, so you don't really need that particular credential as a sophisticated,
there's a loophole.
Sophisticated investor to invest. The other way around it, which is also a grey area, is through a lot of various legal documentation. You could, this is where it gets tricky, you could have legal documentation where on paper you're actually lending money, so it's debt, but the money goes directly into purchasing unit trust shares as equity in the syndication. Okay, so it's a very grey area. Check with your tax accountant, check with your solicitor on your personal circumstances where you can fit into this if you really wanted to explore more about sophisticated investor product syndication. I started off nowhere near these amounts, right? I did make a lot of money, but I kind of quit my job along the way or did part-time. So and I've never needed to, at this point in time, never needed to get a certificate. I did at one stage I had to, but at this point in time, I don't really need to because most of the syndications, are with the one developer that I know very well, and that's how I get around it. But that's another thing to explain for another day. Last word of advice: be very careful of scams and frauds. Okay, as I said, some syndications are how would I put it? Some syndications are there to garnish fees off you, regardless of if the syndication makes money or not. Okay, there are some out there that would garnish 10+% a year in management fees, right? I've also seen syndications that have lost money because they've invested or they've bought a property or a project that doesn't make money or would never get off the ground. And basically it's just, come invest with us, grab your money, and then they just slowly carve out their fees until you're left with 5 cents, 10 cents in the dollar. So be very careful. This is why track record is so important. I did mention syndications and unit trusts on a very high level. Okay, I'm not an accountant, so I don't want to be an accountant. I don't plan to be an accountant, and I don't want to talk the accounting speak. But to very simple terms, a unit trust is managed by a trustee, and whatever money they make in that particular financial year, the distributions must be paid out. That's the biggest difference. If it's a company structure, it's held by like a director can control it, but they don't have the responsibility of paying out dividends. So there's the difference there. And the trustee is liable, whereas with the company, the director is not liable for debts. So obviously, there are many other, guidelines, rules, and all that on what the two are. But in a nutshell, that's what I believe when it comes to syndications, the difference between the two. Okay. How do I assess if a syndication is a good deal and sometimes a unicorn deal? Do not be afraid to ask questions, no matter how silly it is. Okay. It doesn't matter. Just ask. I mean, if these syndicators or developers are not prepared to answer your question, consider what would happen if you invest and you wanted to ask more questions as an investor later on, right? If that's the treatment you get, that's the treatment you're going to get along the way. So it might be a good time to look elsewhere. I've always said an equity investment is not a fund, not investment in a fund. I generally avoid funds.
Why is that?
Because with funds, it's fixed, right? You get a fixed return. You're buying shares. If it's property related, it might be valued every year, and it might fluctuate. Each share will fluctuate in price on book, in terms of book value. And when you exit, you need to find a buyer to buy it at that particular point. And then on top of that, most of these funds, they're geared towards income. That's how I see funds. Obviously, there are other funds out there, but from my perspective, when I talk about, I wouldn't say exactly apples to apples, but when I talk about property, syndication, and funds, that's pretty much how I see the difference. And which goes to my next tip or comment: only consider property syndicates that develop property, not syndicates that hold property to rent out.
Okay.
So this is why. So there are syndicates out there. There are definitely funds out there, but there are also syndicates out there to say that, okay, you invest in this, it'll be a fixed yearly return or fixed quality return for the next X number of years, and then, you know, you can sell or decide to do whatever. That pretty much means, yes, there's certainty, but if the market picks up, for example, if you invested in a WA property syndicate, it picks up, you're not going to see the cream. Because they're not in it to develop the property. They're in it to get stable returns. That's a fund, and also with syndicates as well, in a sense. So that's why I tend to lean on syndicates that do property development. Also ask the syndicated developer for their track record, which is what I kind of explained. Read the info, the IM, I call it, the information memorandum, especially the fees that they charge. Typically syndicates, their IMs are very thick. You know, the thinnest one I've seen is about 50 pages, but it's not uncommon to see over 100 plus pages. A lot of the meat or substance is at the back. That's what I'm trying to say. So review the sales rates, the sales pricing, check the escalation on the sales pricing to say, okay, what has the developer or what has the financial model incorporated in terms of escalation, because that directly will hit on your return on equity or return on investment, right? Because all they need to do is say, for example, my sales pricing, I'm going to bump it up, you know, as soon as I launch year one, I'm going to bump it up 5% every single year until the project finishes. That's got huge ramifications on your gross profit at the end on paper. It doesn't mean that you're going to get that. It's just that when you assess the IM, assess the initial numbers, if they're playing around the numbers and bumping things up already, right, your actual true reflection of the return on equity or return on investment is going to be much lower. So that's one to look out for. Do research yourself. What I mean by that is go to Google Maps. Look at where the property is located or the project is located, what's around it, right? Do some Googling on the council or municipality that the project is in. Are there any plans for the future? What are developers doing? And especially, what are the sales prices at the moment in those areas? Because if for example, you know, if your neighbors at the moment in that particular area are selling house and land for 500 grand, for example, and you're about to invest in a syndicate that's developing house and land packages for 700 grand, there's a 200 grand gap difference between your neighbors. Now, if I was a valuer, I wouldn't give a rat's ass between this project or that project. It's the same suburb, right? Which then means valuations will fall short for the end user when at settlement. It also means that most likely along the way, the syndicator or developer will have to drop their pants on pricing to match, which then straight off the bat, a 200 grand difference in gross revenue per block is a lot of money, and it affects the bottom line. So check the financial modeling, do the numbers align. One thing that I've seen historically with syndicated products in the IMs, their financial feasibility, those numbers don't align with what they're reporting at the front in the headlines at the first few pages. So just make sure that it aligns. Check the risk profile. What is the status of the project or the property? Is it zoned? Is it not zoned, or whatever? Now there are exceptions to this, and I did mention about a unicorn one. We've gone back 18 months now, almost 20 months. We picked up a parcel of dirt that was unzoned in Margaret River in Western Australia. And we knew it was going to be a 6-year rezoning process. We're talking about, strategic planning, basically a new master plan over the, or precinct plan over the area. We knew exactly what was going on. We had council support, and we bought it for a song. And that's what I consider a unicorn. It's that good. We don't even know what the returns are. It's a 10 to 15 year project from start to finish. It's still going through its zoning. We don't know what the returns are as we speak. 10, 15 years, we're probably talking, I personally believe it might even hit 600% return. Okay. That's very good for a property syndication of this. But obviously there are risks. So I'm not saying every deal is a unicorn deal. You just have to make sure what status the project is in.
Mm.
Also check how much equity is required and what the equity is used for. Because in a lot of these syndications, when you drill down to the numbers, right, they'll say, oh, for example, we need $5 million, right? There might be $1 million going to the middleman. Does that make sense? So somebody's got $1 million in their pocket already, right? Also check that the LVR stacks up, because you need to have sufficient equity cover in order for the funder to lend you the money for the construction. Typically speaking, it's anywhere between 65 to 70%, lesser if you're talking about commercial property, syndicated commercial property.
Have you seen any issues lately with developers that have been planning a project for a while, and because interest rates have gone up, they can't get the loan that they thought that they could? Correct.
Yes, I was about to say that. So the equity covers not enough. So for example, I know a syndicator / developer. He's got about $3 million in equity in it.
Yep.
And it's a office, 5-story office tower. And basically he's shopped the market and nobody's willing to lend in that space unless he coughs up another $1 million in equity. And he tried to sell it during COVID. And now he's just bit the bullet and said, yep, I'm just going to develop it. And he's out there trying to raise $1 million. And I'm trying to help him do that at the moment. Okay.
Office space is hard at the moment.
It is. Which is why in this particular deal, if I was going to invest in that project, I would not go in as an equity investor. I would go in, from his perspective, it's an equity investment. From my perspective, it's a debt. So I'm lending the money. So I know I'm going to get fixed return and a duration, right? So, and then obviously he's got to have he's got to put up his securities, director's guarantees, all that kind of stuff. It's pretty much a commercial loan, a private commercial loan. But I know I'm going to get what I'm going to get at the end, right? And that's also to help him along the way. Which is why the next thing, how sensitive is the sales rate, sales pricing, anticipated return on equity, or sometimes people call it return on investment. So ROE and ROI are pretty much the same from my perspective. And only consider syndicate if it's direct investment into the holding entity of the property, and if possible, unit trust. So none of this stuff where we're syndicating, for this amount, and the syndicate is gonna, as an investment vehicle, it's just gonna lend money to the property developer. That doesn't fly, right? If you're gonna be investing in a syndicated project, you're gonna have to be investing into the entity that holds the land as bare minimum as a security, right? Okay. Don't forget, you're in bed with the developer or the project trying to develop it, right? You're not in bed with anyone else or anywhere else. As a rule of thumb, the ROE I would look at in the IM or information memorandum is between 15 to 20% a year. That's my hurdle minimum. Pretty good. It might be higher, might be lower. I'm talking about simple interest, right? Because some of these projects are 3 years, some might be 5, some of them might be 6. So when you do average it out on a yearly basis, for example, if that project is returning 20% a year in my books, and it's a 3-year project, the return on investment or return on equity should be 60%. So you get your $1 plus the 60 cents back after the 3-year period. Not to say that sometimes you might get an early release of or return on equity because the developer just doesn't require that money anymore because of the cash flow. Obviously, the cash flow peaks, and then as you get profit coming in the door, as people settle, right, you don't need that much anymore. You still need to borrow money to finish off the project, depending on where it is. But and this is the beauty of a unit trust, because if there's excess money, right, they have to, because it's a unit trust scheme, they have to give it back to you, right? If they don't need it, they have to give it back to you. This is why it's so important, unit trust scheme. Okay. Also ask, what is the syndicate's exit strategy? All right. Some syndicates, might say, oh, we're going to develop, but we pretty much don't want to sell it. We might get another syndicate to buy it off this syndicate. That's a big no-no for me. Why? That the middleman or whoever the syndicator is collecting fees at the development stage, collecting fees at the next syndicate's holding stage.
Mm-hmm.
It would eat into your profit. And also, how do you know that the development syndicate is not selling it at market rate or better? Because you don't really have a say. Remember, you're just an equity partner. You're not the person who's managing it all, right? Obviously, it's subject to voting and all that. But end of the day, you know, if you're not a big investor, you don't have a big say in it, which then means that the property might be sold at a discount to the market, to the next syndicate, right? So this is why, what is the syndicate's exit strategy? And last but not least, the pub test. Can you explain in simple terms what you're investing in to someone? Now, if you can't explain what you're about to buy into, go back to all this stuff and make sure you do your research, or this is probably not for you, okay? So I'm not saying jump in straight away. It takes time. You know, it's not easy reading through 100 pages of a document for a syndicate and then say, oh crap, it's not for me, and then going to another syndicate, reading another 100 pages, and it's not for me. Once you start getting into the habit of knowing what to pick out in these documents, very quickly you'll find out exactly if that syndication is for you or not. Okay? And I'll go to the funding, my model, right, to semi-retirement. So all things being equal, right? This is how I've done it. All things being equal, and this is not financial advice. Like any of my other slides, it's not financial advice, right? I'm just trying to share with you exactly how I've done it. Now, everyone's circumstances will be different, but for example, when I started off with, I had about 150 grand up my sleeve. I didn't need to have 150 grand all together. It was staggered over 3 years. So basically, you know, 50 grand first year, all things being equal, if all the syndicates were 3 years duration, right? Returns, I'd stagger them, like some are 60, some are 70, some are 50, whatever. I've just put in some random numbers in there. So basically, first year, if I popped in 50 grand first year into a syndicate, a new syndicate, at the end of year 3, which is finished, at year 4 is when I'll get the money back, right? At the start of year 4. So my 50 grand at 60% return on equity equates to 80 grand. So you got your 50 plus your 30. Your 30 is your gross profit, right? And I'm repeating. The second year I invest another 50, third year I invest another 50. So that makes up my 150 grand component, right? In the 4th year, on the 4th project, because I'm getting back my 50 grand and I'm getting my gross profit, mind you, got to pay tax. So this doesn't take into account tax. If I was to then dump this money as 80 grand into this project, right, you can actually see on year 5, another dump 80, another year 6, dump another 80. There'll be a shortfall in year 6 of 5 grand, but it doesn't matter because I'm not saying retire now. What I'm saying is you still need to keep your day job until you get that cycle churning, right? The cycle really hasn't churned yet. It starts churning at around here, right? It starts snowballing into a lot of money because you're I wouldn't say you're doubling up, but you're reinvesting all this money back into new projects, which then means by about year 9 and 10, right? Depending on obviously what the return is, you can potentially get a passive income of 70 grand. Obviously, year 12, this one is at 45%. I've just put it in there just to, you know, trick everyone. But you see what's happening. This is obviously over 12 years, right? I've managed to do it in 7 years. And how I've done it is I've doubled up some of these numbers and I've pumped in more money around year 3 and 4 and 5, whatever, depending on what project it is. Not every project finishes at 3 years, you see. So you just need to really map out, do a simple spreadsheet, map out your cash flow to say which year you need X amount of money to sustain your living expenses, which forms part of your retirement strategy. I've managed to do that. Having said that, COVID really hit us hard because everything was at a standstill. Some of the projects that I've invested in, we've got 3 caught out. They're all 3 years later. Okay. So that's what's happened. But it doesn't matter because I know that because the other thing is the worst thing you can do is if you get, for example, if you invest in project number 2 and you don't make your 70% return, you don't make anything, you only get 50 grand back, right? don't let that sway you to stop this model, because once you stop this model, mate, you've killed all the hard work that you tried to do, and your actual semi-retirement strategy has gone out the door. So it's a numbers game, and it's you need to keep investing pretty much every year. Get that wheel going, get the money coming in, and get the money going out as well. Obviously, up to a certain stage where the money is pretty much generating itself into other projects, and you be able to then use a part of that profit to semi-retire, cover your expenses. I'm not sure if I explained it properly or whatever, but I've tried to explain it as simply as possible. I might get a lot of questions, and as I said, anyone who's got questions, give me a buzz. Right? I'll be able to explain it a bit more carefully and in a bit more detail, because there's so many variables in this model. But I've kind of simplified everything to tell you guys this is a 12-year cycle, and if I started with 150 grand over the first 3 years, at year 12, right, I would get 174 grand back, plus all this other stuff that's still invested in the pipeline, still coming. Right, so I'm getting 72, 54 in profit. I'm getting all my money back. So if you add up all this profit, it's quite a lot.
Okay.
Right. Yeah. So
I can see how this model. I can see how this model would work when the projects go well, when property prices are appreciating. This is why, as I said, with what I said with the checklist, check the sales rates, check the sales pricing, check the research. It's probably a little bit easier for me because I'm in property development, and I know where developers try to cheat and lie and beg and borrow or whatever to prop up their numbers to get investors, equity investors. So and this is why when you find a good syndicator / developer, stick to it, because it means that once you get that trust going, it also means that whatever unicorn deals do come up, you're not going to be placed at the very end in terms of trying to subscribe into the syndicate, because we've experienced heaps and heaps, time and time after again, where people want to buy, and we say, sorry mate, the syndicate's only for $4 million or $5 million, it's oversubscribed, we just can't get any more people in. So this is that's the next part of the relationship, that you need to establish with a respectable developer / syndicator. How does the model work in an economic downturn?
Okay, in an economic downturn, so for example, Perth, I probably didn't explain it too well. Western Australia has always supposed to be, pick up a long way, but it hasn't. It's stayed stagnant even prior to COVID. It stayed stagnant for the past 7 years, 8 years, right? Everyone was betting on Perth, going up, but it just didn't happen. And when you mention the economic downturn or whatever, this is where the sales rates come into play. There's always got to be a fundamental underlying demand for new house and land or new homes, right? If the project has allowed for the sales rate in such a depressed environment, right, it doesn't take up too much for it to swing upwards, and you will make gazillions more than what you invested. And that pretty much hasn't really addressed 100% of what you're saying as an economic downturn, but it then tests what exactly the sales rates and all that, and the revenues are being put into the IM. As I said, it all comes down to the research. And all along, most of my syndicated investments are all in Western Australia, because 10 years ago, right, I already knew Perth was going to blow up, as in go up, but it just hasn't occurred, and we've been still doing very well. Does that make sense? And Perth, has been depressed for a long time. It's now seeing lots of green shoots. It's still nowhere. Even if it goes back to being steady, right? It still has a fundamental underlying demand to it. There are still people buying, wanting to call Western Australia home, right? And if you can if what you push out to the market and what collectively the development industry is pushing out to the market is not oversupplying that market, then it should be fine. People are still going to have to buy. So I'm not sure if I've addressed you 100% there, but for example, look at COVID. COVID was a big hit to the Perth scene. People were dropping at the early stages. Developers were dropping their pants. On a 220,000 block of land, they were dropping their prices 20%. So it's like 20%. If we continue developing one or two of those projects, we'd be losing money after the development. So as a whole, we said, let's just put it on ice, wait until the market corrects itself, or at least work out exactly where the hell COVID is going. And obviously now it's coming back slowly. And the next part of the issue is all these builders going bust. So because of the inflation and the price rises with all these build contracts. So you just need to understand what the hell is going on in the property space. You don't need to be an expert in it, but do read up exactly what's happening. If you are determined to want to explore property syndication in a particular state, make sure you know what the state is doing. So, for example, in Victoria, mate, that short stay levy came in overnight without industry consultation, 7.5%. Mate, as an investor, that's like, why would I invest in Victoria anymore? I'd go elsewhere.
Okay,
right?
So I think you just answered the question, that last thing that you said. So if I was a share investor and there was a slump in mining, I could move to retail, I can move to banking, I can move to another sector. As a property syndication investor, what you do is you move, but you move to a different state, you move to a different city. So there's always some growth somewhere, and it's your job to find a project that is syndicating in a city that's growing.
Yep, and there's always an underlying demand in property, right? Property, apart from mining, property is probably the next one, and then closely followed by hospitality. Manufacturing is probably very last, So
property and mining are the two things that's holding this holding this country up.
Exactly. So, anyway, some of the past projects, off the top of my head, there's about 15 that I've done over the years. These are mostly apartment projects, and I probably forgot to explain. When you invest in apartment projects, please don't invest in apartment projects that are bloody multi-story, so bloody high density, takes forever to build, forever to sell, right? These are like, for example, I've got 21 townhouses. Get in, quick, sell, develop, get out, right? These are all 3 to 3.5 year projects, all these ones that I've got up here. So 24 apartments. I've got a bigger one, 70 apartments. That's just finished. 22 apartments, and then also when I talk about doing your research on the developer with their track record, look at what they're doing that's different from other developers in the market. This one that I've partnered with, they did Australia's first battery harvesting system built into their project, and it's run off blockchain, which means that they were able to, apart from supply electricity to each of the residents at a discounted rate, they were able to, with the excess power, sell it back to the grid, and then cover off all the OC fees. So
where were they getting the energy? Was it solar? Solar panels. Okay, gotcha.
With battery. This was a partnership with a university, a prominent university in Western Australia. Mm-hmm. So this is what this developer's doing. They're leaning towards sustainability. When you go for luxury, right? Luxury and sustainability probably doesn't go hand in hand, which is probably why if you have a look at some of these projects, they look pretty crap and ordinary or whatever, from my perspective anyway. But if you then look at their pricing point, you then look at what they're trying to offer, the number of apartments, how big or the size, and what the returns are. At the end of the day, they're still delivering a product that meets the market. And this is the one thing that you also need to look out for. There's no point developing high-end residential, mega penthouses if nobody can afford it, right? Always develop in a syndicate this is what a syndication is. If the syndication is developing for the needs of the local demand, you've got half the battle already sorted out. And this is what it's doing. These projects are meeting the market, right? None of this is luxury, right? This is all plain stuff, except for this one where it's battery tech. Okay, so they're townhouses and / apartments. I then go into land. So at the moment, this is only a snapshot on a few. This one's 70% sold. These ones are all pretty small. When I say small, they're around 100 lots, right? Anything under 50 lots, you're probably wasting too much time on as a developer, because the amount of effort you put into a 50 lotter to the amount of effort you put into a 300 lotter is almost identical. Does that make sense? So, you know, how would I put it? The niche for this particular developer is around this. Yeah, it is always around the 100 lotter mark. There are some big ones, there are some small ones, but it's always around the 100 lotter mark. Why? Because it comes back to the underlying issue of supply and demand and sales rates. So these syndicates, they reported sales rates that match the market. So 5 a month, for example, or 1 a week or something. So if you were to work out, for example, this 94 lotter, right? If you were to sell 1 a week, that's just under 2 years of supply. Does that make sense? Which then means it takes you another 8 months to build, and then the planning permit is probably another 6 to 8 months. So you can actually work out very quickly, right, from start to finish, when the project is ideally going to finish. Doesn't match up to what the syndication IM is saying. You know, if this syndication was saying, I'm going to finish in 3 years, right, and my sales rate is 5 a month, I'd be saying they're telling you fibs. Because straight off the bat, you can work it out. You work it backwards, right? But if they're saying my sales rate is 8 a month, and it's substantiated with a lot of these other sales professionals and their reports to say it will meet 8 a month as an average, then yeah, you'll probably do it in 3 years, no problem. So this is where sales rate, pricing strategy, sales strategy come into play very importantly. Land is a funny beast. Most big boys or most big developers want to do big master plan communities, and that's what I used to specialize in. I'm not saying that they don't make money, but if you were putting your money in as a syndicator, syndicated investor, it's going to take you a while to see your money back, because most syndications would pay out at the end of the project. So, for example, instead of 94 lots, this was a 940 lotter, right? You probably get some interim dividends or interim return on equity along the way, but you're not going to see 100% of your money or profits back, you know, for another 10 years or something, depending on the sales rate. So this is why you need to look at syndications with a quick turnover, which then feeds into that model I was trying to explain. And you just need to make sure you cash flow it out for, you know, and when you invest, say for example, year 1, I invest in this project that might take 3 years. In the same year, another project might appear that might take 4 years. Now, do you proceed and invest in it? Mate, if it checks off all the boxes, I would, because I know that in year 3 and year 4, I'm pretty much, I won't say guaranteed, but I pretty much know for certain where my money is roughly coming back, right? Which then means when I go to, because I'm in year 1, right? When I go to year 2 and there's another project that takes 3 years, I can afford to say, I probably won't invest in this one because I've already invested in one project that takes 4 years in year 1 that will cover my year 4. Does that make sense? And you just make sure you're able to cash flow out your own personal finances and to fund this this snowball effect.
Yeah. So if you look at, and if I compare this to like buying and owning an investment property where you get rents every year, this is buying like one property and you're getting your rents every 3-4 years, and just managing your cash flow through buying multiple syndicates and having the cash flow cover your costs over years, as opposed to every week.
Yes and no, and without the hassle, because
without the hassle.
yeah, a lot of people fail to understand that when you buy an investment property as a mum and dad to rent out, it's not just a numbers game. All right, yes, you want yields. Yes, you want. If you get a bad tenant, mate, I've experienced it before, and this is why I'm totally out of property. I used to own quite a few investment properties, and I just said, stuff it. I've just had it with these tenants, right? And I've just sold everything and dumped all my money and started off. Some people said I was an idiot when I started off doing this, but because I knew what I was doing, and I wanted to prove myself I could do it. Once I had the first batch coming back, people started to understand, oh, this is what you're doing. And then I was getting relatives, friends, and I was trying to convince them this is not a fraud. I'm not trying to peddle crap to you. I'm genuinely in it and trying to help you along to make sure that you get financial freedom as well. You know, because I'm in the process of enjoying my financial freedom. This is back then. And I, you know, as a friend, as a relative or whatever, I want you to do the same. And this is why I have a very loyal following. And in particular, when new syndicates come up, you know, this developer gives me first go at it. I look at the numbers, and if it suits me, I put in money. I don't say I put all my eggs in one basket. I put a little, and I also use my own super money under SMSF. So that's another kettle of fish. And I think David touched on his SMSF for his commercial properties. There's SMSFs for all other reasons. I pulled out all my super money and I put it into syndication as well. So apart from my retirement fund that's growing, my living expenses is also covered along the way with my other money that I invested under the company. So this is why it's important to be best friends with your tax accountant. You know, there are quite a few tricks up your sleeve. It's nothing to do with tax evasion. Pay your damn taxes, right? Nobody can escape them. Pay your damn taxes, but there are ways to make it more effective from your perspective. And you know, as David said with his commercial stuff, there's also lots of tax effective stuff that you can do with from your end as well. You know, setting up family trusts, setting up companies. You know, family trusts is no different from a unit trust where every year all the money has to go out, right? Don't invest in syndicates using a family trust, because you know if one year your syndicate returns 200 grand and you're the only beneficiary in your family trust, right, you'll be paying 200 grand worth of income tax.
Yep.
This is where companies come into play. You know, turn on the tap. You know, close the tap. In terms of dividends straight to the unit trust or the family trust, and then they can distribute it out depending on what money you make that year. So there's all these other tricks. That pretty much sums up. Have I missed anything along the way?
No.
Yeah.
You talked about what is a syndication, what are the good things to look for, what does the cash flow look like, and you gave some really good examples of some projects you've worked on.
Yeah.
Thanks for that, mate.
Yeah, as I said, you know, questions, just give me a buzz. You know, all I can do is try to help. Nothing is financial advice. I always tell everybody, you know, first thing, I'm not a financial planner. I'm not licensed. All I'm trying to say is this is what's worked for me. It may not work for you, but it's up to you to do your own research to make sure that, you know, you're not missing out on something.
Awesome.
That's it. I mean, end of the day, everyone's goal is to retire and to be financially independent at retirement. How you get there, there's so many ways to skin a cat. I mean, this is not the right way for many. It's the right way for me. Doesn't mean it's the right way for you, right? So, you know, you just need to suck and see, maybe dabble a little bit, and never borrow. My next thing, never borrow money to invest in syndications.
Why?
Because syndications are not fixed in terms of their duration. So if you, for example, if I borrow off an auntie, right, I'm going to borrow from my auntie 50 grand, for example, and I promise her I'm going to pay her back in 5 years. If this syndicate doesn't return the money in that time frame that I promised my auntie, what's going to happen? You're going to have
a grumpy auntie,
a very, very angry auntie. Right?
Yeah.
This is why don't try to borrow money off other people. Don't borrow debt and try to convert it to equity to invest. That's what I'm trying to get at, right? You could do it. I mean, but that's at your risk. That's just another risk profile that from my perspective, I probably wouldn't touch. And if you were really keen on syndications, start off with around 200 grand, whether it's your own money or savings, or whether you've got enough in your super to create an SMSF to play with. Because
did you say start off with 200,000?
Yeah, total. In a single
no, syndicate?
Don't put all your eggs in my basket. What I'm saying is start off with 200 grand, right?
Okay.
You might dump it over 3 or 4 projects.
Gotcha.
Yeah, don't put all your eggs in my basket, but you still have to have something. What I'm trying to say is don't say I've got 50 grand. I want to pump it into one syndicate, right? Wait 3 years, 4 years, 5 years, 2 years, whatever it is. Wait for the money to come back and then say, oh, I'm going to do it again. What's the point? You might as well just put it into something else, because you're not achieving that cycle, right? Where you're trying to build on your wealth to get your passive income going. That's what I'm trying to get at. Yeah. Okay. That's it. That's pretty much sums it up. I look forward to anyone giving me a buzz. This company is still mine. Our website recently got attacked, and I've taken it offline. So I did have an email address. I still use it. I don't want to disclose it. You can always give me a buzz or text me or something, and we can talk. I've got no issues. No charge.
Awesome.
Whatever. Happy to share my experiences. Yeah. Okay.
Thanks for your time tonight, Nelson. Appreciate that.
Thank you very much for the opportunity.
Cheers, mate.
See you then.